We are now at near the end of the day. We're going to talk a little bit about advertising Regulation A offerings. And we're going to talk about it in two ways. We're going to talk about what works and what doesn't work, what is effective advertising. And we're going to also talk about what's legal and what is not legal in advertising. Nick. Here's Nick. He saved us. And we're going to do all of that in 35 minutes or even sooner, because I think the conference as a whole is running late.
There's Nick right here.
Okay, and
Mic over so you be.
I like panelists, I'm sure these will be, to be frank and honest, and they're talking about things that work and don't work, to use real life examples and names. This is being recorded, so if one of you is not sued for slander after this event, I'll be disappointed. Okay? Two of you would be great. I guess we very quickly, 30-second self-introductions of each of you. Go ahead, Bonnie.
Okay, so I'm Bonnie Rowe. I'm a securities lawyer at Cohen and Gresser. I began my career doing tons and tons of IPOs, and sort of like the Jobs Act, I ended up either advising much larger companies or helping much smaller companies raise capital. I'm also the head of the ABA's Small Business Issuers Committee.
I'm Gene Massey with MediaShares. MediaShares is primarily a marketing company. We have a long history of advertising. We even did the Callaway golf spots for 7 years, handled their broadcast advertising campaign that took them from 20-something million to 800-and-something million. We've got awards from Clio, the New York Festival, multiple Telly Awards, World Festival. And so we took that expertise and applied it to fundraising, and now we help companies market their offerings. An offering is a securities offering is very much like a product has the same need to reach a large audience. And so that's what MediaShares does.
Okay, and Nick.
Thanks. My name's Nick Bhargava. I'm one of the two co-founders of Groundfloor. Groundfloor is a peer-to-peer lending platform. In a similar vein to Lending Club and Prosper, what we do is we originate short-term real estate loans to professional builders and developers to fix and flip single-family and multifamily housing, do new construction on single-family, multifamily housing, transactional finance on land, et cetera. We use Regulation A to turn these loans into retail-facing investment products. So retail investors can log on to our platform and participate in the loans. Minimum investment amount's $10.
Yeah, and every time, I've done a bunch of panels with Nick and his partner, and they always understate the significance of what Groundfloor has done. I know you guys are so low key, but really Groundfloor has been a groundbreaking company. You heard him say they offer $10 minimums, and you use Regulation A, so you are offering securities not merely to accredited investors, but everyone.
Correct. The capital formation on the platform is driven by retail investors, not institutions, high net worth individuals, or otherwise accredited investors. So 90% of the investment product that we put out through Regulation A is acquired by retail investors. So we're on track to sell about 100 million of securities retail facing.
And just an interesting question in that regard, you must, because Regulation A has different rules for accredited and non-accredited, you must keep track of which of your investors are and are not accredited. What's the breakdown of that 100 million between accredited and non-accredited?
So 100 million this year is going to non-accredited.
100 million? Okay,
Correct.
and as a percent of your investors, I mean, I assume
It's about 85%.
85%
Correct.
non-accredited investors, even though it's the accredited investors who have all the money.
Yeah.
Now, is that because of something you do? Is it the way you market the site? And let me ask you more generally, it's a
Right.
question that I have for you. What are you selling? Are you selling an investment? Are you selling a platform? Are you selling an idea?
We're selling an idea. What worked for us is a lot of online marketing, building a very cohesive story around this idea, which is that there is an asset class out there, which is high yield debt on real estate, backed by real estate. That's an untapped market for retail investors. The majority of the financing to builders and developers for this type of real estate development is coming from institutions, and it's highly fragmented. Furthermore, 2/3 is actually done with 100% equity. So there's a lot of potential to come in there with a debt product for these builders and developers and market that debt product to them. So there was an opportunity on the credit side to move into this market, and the nature of that credit made it very attractive for a retail-facing investment product. If you look at a retail investor, what resonates with them is a low barrier to entry as far as the investment size goes, right? High minimums don't work. It needs to be a uniform product, something that's very easy to understand. Not a lot of bells and whistles, something that's very straightforward. It needs to have a defined time horizon. Retail investors are typically very difficult to convert the longer the investment time horizon is. The credit we originate is 12-month credit. Most of our projects turn around in 9 months. It's classic acquisition and development finance. So to take that and turn it into a retail-facing product, there was a lot of congruence there between the credit side and the investment side.
But how do you get them to come to your site in the first place? Because, you know, people call me all the time, I want to use Regulation A. I say, how are you going to raise the money? We're going to have a website. I say, like, there's 1 billion websites, and a lot of them have, wow, really cool stuff. How do you get retail investors to visit your site? What channels do you use?
Right. So deal marketing is difficult for a lot of reasons. There's a lot of risk from a regulatory perspective in going out there and marketing on a deal-by-deal basis, and it just doesn't convert. A deal in and of itself delivered through an online medium, it doesn't tell a story. You have a very limited amount of space and a very limited amount of the user's attention to try and convert them through online marketing. All of our marketing is online. We built this platform by acquiring our customers primarily on Facebook. And the marketing tools we use, the ad units we developed, were designed to tell a story. And that story was the story of our platform, what it is we're trying to build. The fact that this was a platform built for the retail investor, first of all, to address a specific need that wasn't being met, which was a asset-backed, high-yield investment. And furthermore, the narrative is always made clear that this was a world that was previously locked out to retail investors, right? Because this type of financing is majority done through private placements. It's all HNIs and institutions.
Yeah.
Retail investors are wise to that. You know, they're aware that a huge amount of financing takes place in the United States that they'll never get a chance to see. So building a story around that and then marketing around this story was more effective for us than trying to go out there and market deals.
Okay,
I've actually used their website in some of my talks as an example of how good and simple it is. Everything they do is so well laid out that anyone can see it and see the percentage, the length of the loan, the fact that it's got collateral underneath it. It makes it a really simple presentation. And I recommended them to two of my friends who both invested in them from seeing that.
Well, that was a total of $20 they got then. Okay, Gene, so you are a marketing consultant. You guys do marketing, and I've known Gene forever. Tell me what you think goes into the decision an issuer. So an issuer maybe calls someone like me first, maybe calls someone like you, and I say, you got to talk to a marketing person. It's all about marketing. Tell me how an issuer, what should they be looking for when they are choosing a marketing company for their Regulation A offering?
There's something in the advertising world, which I was in for many years. I used to work with big New York agencies as a TV commercial director, so I learned to tell a story in 30 seconds. And so there's something that they all do when they're changing clients. When Toyota decides we're going to change agencies now, what they do is they allow people to come and make presentations to them. When clients want to change agencies, they will allow the agencies to come and make presentations. And very often the agencies will spend $1 million making a presentation to get the Toyota business.
I think who here's a Madman fan, right? We saw that. So nobody?
Okay. My suggestion to someone that is looking for a marketing company, say what your budget is, and have people come make presentations. Don't necessarily go by what they've done, because they may have done something that was fairly easy, a certain type of product or something, and they say, well, we did the so-and-so campaign, and oh my goodness, they got all those millions of dollars for that particular campaign, which might have had a very interesting story. It might have been a product where everybody went, wow, look at that, that looks great. That may not apply to your product. So what you want to do is you want to go out to people, marketing companies, and say, make us a presentation. You want our business? You want us to give you a few $100,000 to market our Reg A offering? Come make a presentation. We want to know exactly what you are going to do, how you're going to spend the money, how much is going to go to this, how much is going to go to this, and show us how you will test that budget in various areas before we spend all that money with you.
Okay, and tell us what that budget should be. Because people always, if there are any issuers out here, so only issuers call me, and they always want to know how much is it going to cost. And what they're thinking is, how much is my fee going to be? Because they think that the legal fee is really the big number. I always tell them, well, I'll tell you what my fee is, but you're going to spend multiples of that on marketing. So what should people expect?
Well, the thing to remember in all cases, the thing to remember in all cases is that these are people that are looking for money, and they say, well, you know, we'll give you a percentage of what we get. So no, we can't do that. We're not brokers, but we want to give. What you'll do is you'll walk it up. You'll say, okay, we might spend as much as this, but we want to spend $50,000 now to see what you might do. And you take that money, and they take that $50,000, and they come back with several $100,000 in investments, and you take the money that comes in, and I've known companies that would, with the Reg CF offering, they would walk it up. When they got $20,000, they'd take half of that and spend $10,000 on marketing, and then they'd get another $40,000 with that, and they'd take part of that money, and then they would walk it up to $1 million. That's how they would do it. And in the end, they would end up spending about $1 for every $10 they got in investments.
Do you think that is a rule of thumb in the regulation?
$5 to $15 per $5 to $15. You could spend that much.
No, 5 to 15. What does that mean?
For every $1 you spend in marketing, you could get as little as 5 or as much as 15, depending upon your product. Now, if people see a product that's, oh, wow, an electric bicycle or something, some toy that you stand on and you can fly around it or whatever, but they see something that's so exciting they'll want to invest in that. And that's what's happening a lot of times in Reg CF. You know, the companies that are starting on Reg CF and then moving up to Reg A, they'll have a product that everybody's really excited in.
Yeah.
And they'll go on a portal, and then they go on up to Reg A after they start getting some big money.
Okay, let me just ask you one more question since I'm on you. Testing the waters. We all know what testing the waters means, right? In the Reg A space, you can start advertising before your offering is qualified, and you can take non-binding commitments. The question is, in Regulation A offerings, does it work? Does it validate anything?
It can, and it might not.
Are you a lawyer? But I mean,
It can.
it can. Have you seen it effectively validate?
The hard part is, if you're going to test the waters, where are you going to test the waters? You're going to test the waters at a conference, test the waters on a Facebook campaign, test the waters on an email campaign, a combination of those things. So it depends on where you test the waters and how you test it and what your product is. But in general, there's really no other way. You have to test the waters because you want to see, before you spend all this money on a campaign, is this something that's going to work? It's probably the best thing about Regulation A is testing the waters. You couldn't ever do that before. And they're even talking about now, they're going, well, yeah, how come we can't do it with an S1? And so they're even talking about making the change now and allowing other companies, other exemptions to be able to test the waters, because it does work, and it just, there's no secret formula to it, but you have to do it.
Okay. Bonnie, we've talked a little bit about, what's worked, or what works, what you should do. So can you give us a brief overview, no more than an hour, of the legal rules, say, that compare advertising a Reg D offering, a Rule 506C offering, vis-a-vis advertising a Regulation A offering?
Yeah, I think I can, and the easy part
That's why I asked you.
the easy part of this is that the 506C part of the explanation, is there, you can't commit fraud. And that's basically it. You have to comply with Rule 506C, and you can't commit fraud. When you get to the Reg A aspect of it, you have to, first of all, distinguish between what's normal non-offering stuff, regular company marketing, and testing the waters. And then you have to do the compliance for testing the waters. And then you, at the end of the process, when you're qualified, you have to, or just before qualification, you basically have to have all your testing the waters materials filed with the SEC. So there's a long, history of what you've done. Even further than that, when you make offers after qualified, you have to make sure that you have accompanied everything or preceded it with the final offering circular. So that's my less than an hour
I just want to focus on something that Bonnie just said, because I bet a lot of people didn't get the import. So what often happens is people think of their offering circular as a way to get qualified so that they can sell securities, and it is certainly that. But then they get qualified, and then they think about marketing. So now we can sell securities, now let's do this website and think about all the things that we really want to say about our company so that we can sell these securities. We want to talk about our track record, we want to talk about all these things, and they can't if it's not in the offering circular, right?
Right.
You can only say stuff that you have said in the offering circular.
You might say it in a slightly different way, but you cannot say it.
Yes.
If
And
it's
and I
not
just
in- Yeah.
can't overemphasize that. So Regulation A, as is probably evidenced if we took a poll of those who attended this conference, Regulation A is two things. It's a big private placement for people who come from the private placement world, or it's a tiny IPO for people who come from the IPO reverse merger world. And people who come from the private placement world are astounded to learn that there are any rules about what they can say, right?
Right.
So for example, here's an example. In the Rule 506C world, particularly in real estate, which is 90% of Rule 506C, target IRRs. Everything is a target IRR. Can you say target IRRs in a Regulation A offering?
I don't think so.
No.
I certainly have not seen it.
No, you cannot. So the rule is you have to balance any statements, positive statements, with statements about risk. You know, you might make money, but, you know, who knows?
I can't say you're going to make a ton of money on this.
Can't say that. And you can only say stuff in your offering circular. So anyway, so that means when you're doing the darn offering circular, you got to think of all this stuff that you're going to put in beforehand. Can you tell us a little bit about the rules around testing the waters?
Sure. Basically, what you would be doing is that whenever you're trying to solicit an interest in your offering before even before you have filed confidentially, you need to basically have a disclaimer which says that you're not asking for money, and if you get money in response to the solicitation, you will return it. It says that that offering to purchase the shares is not binding, that offers can be revoked, and that sales can't be made except pursuant to a qualified offering. And so that disclaimer goes along with, you know, your email, your website. There are questions about, let's say you have a media presentation. Can you have a little scroll below the media presentation that has the disclaimer? One thing I need to say about the disclaimer is that once you have filed publicly, it has to also contain a link to the public filing. And so that's essentially the case. If you contrast that to what you can do if you're an emerging growth company in an IPO, they can do testing the waters as well, but they can only go to qualified institutional buyers or institutional accredited investors. You can do testing the waters with anyone, with retail investors, with anyone. You sometimes have to worry about whether what you're doing is an offer in a state that you didn't expect you were going to file in. That's particularly true if you're a tier one, if you're doing a tier one Reg A. And then once you have qualified, you do have to file these, and they become part of the public record.
And so I just want to make that point, testing the waters. The reason I asked Gene, does testing the waters work? Because the concept comes from the public markets, where companies, or you're going to do a REIT, there's going to be $1 billion REIT, so they go and ask money managers, you think you'd be interested how much? And the money manager says, yeah, I'd do 50 million or whatever. And it works in that context, because if the money manager doesn't follow through, guess what? He doesn't see the next 3 REITs. She, I should say, doesn't see the next 3 REITs. In the private placement world, again, in this kind of bifurcated world, man, just getting a commitment, let's say you're doing a private offering and some doctor says, yeah, I'd probably put $50,000 into that deal. That promise in 225 will get you on the subway back to Penn Station, because huge difference between making a verbal or even written commitment and actually getting the check. So I think Regulation A is somewhere in between.
I'd like to comment on that. I tell people that it's a good idea to, if you're taking a private placement and you plan a Reg A, tell them there's a Reg A coming, and they get more excited knowing that there's a liquidation event coming at some point where the stock will be publicly trading. So you do a Reg D and test the waters at the same time.
At the same time. And the Reg D offering is kind of a more effective testing the waters.
And you can take the money.
You're getting people to write checks.
And you say, we're doing a Reg A, and we want you to invest under Reg D since you're an accredited investor. And then you can really test the waters, because they really will invest.
Yeah, okay, terrific, and that is terrific advice. Nick, can I ask you something specific to Groundfloor?
Sure.
You guys, do you capture data about what is effective on the site? Like, you show different metrics, rates of return, you might show photographs of developers and their children, you show lots of different things. Do you have data about what is effective for you and what isn't effective for you?
In terms of marketing these investments? So once users are on the platform,
Yeah.
and they're looking at investment opportunities, what drives investment
What
typically
drives them
is...
to click, I want to invest? Do you know, because you test different things?
So it's interesting, because there's a real juxtaposition in the two drivers that investors pay attention to the most, which is rate of return and leverage.
Okay.
So rate of return, right. I mean, they're rational. They really are.
Rational.
So rate of return, they'll click through into the loan details, and then they'll look at next leverage, right? Look at where the property is located. Look at what is being done with the actual loan. Like, what is this? Is it new construction? Is it a rehab? So the behavior is rational, which is encouraging. Right?
It is. It is, actually.
You'd expect it with law of large numbers. But it is the rate of return that drives the interest. And then from there, there's almost like a checklist of data points that investors will typically drill down into, second of which would be the leverage.
And I guess, how do investors weight those two things? Because those may be inversely proportionate. In other words, all of us sophisticated people speaking in Manhattan think retail investors, we're much more sophisticated than them. But what you're saying is that retail investors are actually looking at the right things. Now, do they always choose the highest rate of return, ignoring the risks that come along with that? Or do they balance? It
is generally a balanced decision. You'll always see like an outlier where somebody comes in and they don't have any other investment activity on the platform, but they'll just take a flyer on, a loan that might have 17%.
Yeah. Okay.
Right. But that's once in a blue moon. What you'll see is people actually build a portfolio, like classic portfolio theory. They're going to, if they have $1,000, they're going to allocate 3/4 of that to relatively low risk credit credit that's yielding anywhere from 7, 8, 9%. And then with the remaining quarter, they'll buy down in small amounts, right? Trying to spread across as many different projects as possible, your 13, 14% credits.
And do you see investor behavior changing? In other words, an investor comes in and behaves in one way the first time they invest, but then over time their behavior changes? Or is that something you pay attention to?
Yeah, that's an interesting question. I think in early days when we were just getting started and we were just doing this intrastate to see if we even had a concept that would take off and a product that people were interested in, the numbers we were dealing with were probably just too small for us to see if there was some sort of a learning journey that our earliest customers were going on. It was really when volume picked up that we got a lot of clarity into this type of behavior.
Okay. And finally, one more question, and you don't have to answer this question, but you've had such amazing success. I think surprising many people, not me, of course, no, surprising many people with your success in attracting non-accredited investors in a way that apparently you can still make money. Are you thinking about any other products you might offer to leverage that skill and those relationships you've developed?
Yes, we are, and it's moving into adjacent markets and turning those into new investment products for retail investors.
Okay.
All real estate?
No, not all real estate.
Okay, super. Well, we will be interested to see what you guys come up with. Okay, Gene, you had said something interesting that I wanted to follow up with. Selling securities is like selling products. So I guess my question is, what kind of products? In other words, are they donuts? Are they meaning, detergent? Are they, what's the word that I'm looking for?
Well, no, if you're selling an offering, you really are selling a product. Because,
but is it
because the company...
Is it an iPhone or is it a...
The company you're investing in, you would generally invest because you like their product. People buy Apple stock because of their products.
Yeah.
They don't know anything about Apple other than their products. And so if you have an offering or you're trying to raise funding, you really need to tell the story about your product. And if you go on Start Engine or a Reg CF portal, that's a good place to get a feel for marketing, because you can see the different products and how much money they got. There's even a guy I know, a friend of mine, that got money for a movie. And you go, anybody in the room here would throw you out if you asked them to invest in a movie. But this guy actually got almost $1 million on Start Engine, basically by the way he did his product for his movie.
I mean, are you trying, when you sell products, like you see the Ram pickup truck, masculine, and different products, of course, have different emotions. The agencies try to associate different positive emotions around them. Are you trying to do that when you're selling securities?
No, you're really selling the coolness of the product and why you're selling something that everybody's going to want one of these. I'm working with a client right now that's got a medical screening device. It's a no-brainer. It's paid by insurance. Any doctor would want it because their revenues increase $200,000 a year. Every patient that walks in the door can be screened with this device. It's a real no-brainer. And so you look at that, they don't know much about the company, but they look at that device and they say, well, yeah, doctors are going to want one of these. This is a great investment because every doctor is going to want one.
Do you think, so Nick has told us that in his company, he has retail investors, non-accredited investors, making what seem like rational decisions. Do you think in general, and maybe other people in the audience might have, do you think in general, Regulation A investors are making rational decisions? Are they reading the offering circulars
Yes,
that?
Nick's
that-
company, Groundfloor, is a positive proof of that.
Yeah, but, well, it's either
Positive,
proof or an
positive
exception.
proof of that, not an
Okay.
exception, because people look at it, it's very reasonable. You say, oh, these are properties backed by real estate, they're paying 9% or 12% or whatever the deal is, and it's very clear.
Yeah, but people invested in LEO Motors.
That
right?
was cool, that had a coolness
Okay,
to
but
it.
it wasn't rational.
It was not rational at all, and it's proven to be irrational.
Yeah,
But,
okay.
But people invest in something, they look at something and say, well, yeah, they're either investing a little bit of money because it's cool, or in the case of Nick's Groundfloor, a lot of money because, my friend put $10,000, he took money out of his 501 and invested in there because he said, wait a minute, they're paying 14%? Where do I sign? And it's backed by real estate? He wouldn't have done that for a movie or something, They have a very rational investment on Groundfloor.
Okay, Bonnie, I'm going to pose a hypothetical, talking about what is a legal advertisement for a Regulation A offering and maybe not so legal. True, I'm not going to use the company's names, because I said it was okay for you guys to be sued for slander, but not me. So a prominent REIT company has an advertisement. They've been in business for a few years, and they've so far experienced, we have a super positive real estate market. Hadn't made money. If you haven't been able to make money in real estate the last 7 years, you should probably get a different profession. But so they've had their fund has had a positive rate of return, it's returned 14% per year, say, for the last 3 years. And so on their website, they have a projection going out 40 years. I think it's 40, maybe it's 30 years. What would $10,000 invested today look like if you earned if it compounded at 14% per year for the next 30 years? Do you think that is, and the rule is, particularly for real estate under Industry Guide 5, statements of possible upside have to be balanced by statements of possible downside. Do you think extrapolating 3 years you can tell, how I'm asking the question, but what do you think about that?
Well, that sounds like a dangerous way to go. You could, I suppose, say that if you balance that appropriately, you might kind of make it into something okay, but I would say just don't do it.
And how would they have this chart, which you can imagine what it looks like, or woo? How would you balance that chart?
Well, that's sort of the problem, is that the hockey stick is much more sexy and compelling than something that compared, the upside to the downside, and the comparisons over some historical period, and was essentially, this is how real estate investments of this sort have fared over periods of time.
Okay. And I guess just tell me, so let's say that my suspicion is right, and this is a really deceptive advertisement. What can happen? What can happen to them?
Well, the problem is that what's on your website might be part of your testing the waters material, and that would be part of something that gets filed with the SEC, and in any event is going to be viewed by the SEC as sort of part of the offering document. And that's going to be a distinct no-no as far as...
And so this is happening post-qualification, could the SEC just shut their offering down?
I think that's probably correct.
Yeah. So there is definitely stuff happening out there in the, advertising of these things. It's not something I personally like to see, because those of us who have been in the space since its inception, we, want to see, I know the four of us, maybe not Nick, no, the four of us want to see a healthy, I think everyone in this room wants to see a healthy market for Regulation A offerings. And there is always the temptation, people are always going to be tempted to push the envelope. And when the envelope gets pushed too far, it means that the market is not healthy anymore. So I always say at these conferences, it behooves all of us in this room who have an interest in a healthy market to do what we can personally to keep it healthy. So let me just, we only have, I guess that's our clock. So we only have 3 minutes. Are there any questions? Yes, sir.
I didn't quite understand. It's not you. You had asked the gentleman on the end how he marketed to get so many investors to his site. Could you go over that again? I didn't quite.
Nick, did you say Facebook? Did you guys, no, I'm sorry.
Yeah, well, it at first started on Facebook.
Yeah.
It was Facebook marketing, buying ad units. My co-founder, I mean, this is his bread and butter. He's brilliant at it. So when it was just the two of us, we were already trying to find our prototypical customer profile on Facebook. And at that point in time, we're not even marketing a product or an idea. We were just testing the marketing, like the mechanics of marketing. So that started before we put pen to paper and even put together an offering circular, which was to just understand, okay, what is the acquisition vector we're using? What strategies can we employ that we think would be reasonably successful given the money we're going to throw at it? And we just screw it from there.
And if I could ask approximately, what kind of a budget did you work with?
Back then, it was a shoestring budget.
Well, I was just going to say, yeah.
It was like, no, we weren't spending more than $1,000 a month.
And why were you so successful at it, would you say?
We're not real estate guys. We're not, I mean, I have a finance background, but he's a tech guy through and through. So in that room, in our co-working space.
I'm asking, why do you think your shoestring budget worked so well?
Yeah, so one of the guys we had working with us early on, after he helped us dial that in, was immediately hired by Facebook.
Was what?
So let me just interject and make a suggestion as to answer your question. One of the questions of many that I didn't get to ask is, when do you start marketing a Regulation A deal? And I think the answer, it's sort of a trick question, is you start even before you have a Regulation A deal, right? There are two kinds of marketing. One, you build a widget and then try to sell it to people. And two, you do market research and you figure out what kind of widget people want to buy and who is likely to buy it. And it sounds like you guys,
Did that.
Yeah, that's what we went out and did.
you and Brian, you just figured out what kind of widget and were people going to buy it and how you were going to sell it to them before you started paying lawyers and all
Correct.
that stuff. So that. I just find their story super interesting. Any other questions? Scanning the room. Okay, well, thank you very much for your attention and for sticking around.